In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. Today we are going to look at Teladoc. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share. This is where we take the net income and divide it by the shares outstanding. For Teladoc, this is down -336% for the trailing 12 months. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health, and prefers companies that can generate substantial free cash flow. And here we can see, Teladoc have not hit our 10% free cash flow target, as it is up 67%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Their revenue is also down, at -3%. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value is down by -36%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are not great at -32% and -65%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. It would take Teladoc nearly 5 years to use their free cash flow to pay off the debt. At present, with the information we have gathered, it tells us that Teladoc's key pillars are not looking great so far, but let's find out more. Help support the channel by tapping the like icon if you have found the information helpful, and click on the notification bell to get alerts about my next videos. Now we will focus on other key pillars which help define an excellent business. So let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently at 71%, which is good, as we like to see the gross margin at or over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is -8% and is well below our target of 14%, and explains why they are making a loss. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 21% this looks very good. However, Teladoc Health has a positive free cash flow, because it generates more cash from its operating activities than it's currently spending on capital expenditures. As we are potential shareholders, we will now want to look at the average book value growth for the last few years. This is -26%, with the lowest point being last year at -54%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is very high at 742%. In the comments section, I've included a link to the investors page and the annual report, if you want to check it out for yourself. Now let's look at past historical performance, to give us a better understanding of the company's successes and failures. Looking at the chart, we can see that in 2019, Teladoc was trading at about $78 per share. They grew as high as $294 per share, but tanked shortly after that. And kept on dropping, until this year when they hit just under the $7 mark. They have recently shown a little uplift, but are down about 88% from their 2019 price of $78. We can see the current market cap is $1.59 billion. They are currently generating $2.59 billion in revenue. Their net income is -$981.73 million. And they have 172.17 million shares outstanding. At present, their earnings per share tells us that for each share of stock, the company losing $5.81. The overall consensus is hold, and on average, the analysts believe that the price target should be about $12. Now I am going to show you how to create a valuation. However, I can't use their current earnings per share as it's -$5.81. So, I will give them a theoretical EPS of 20 cents. Now I use a combination of the past growth and future analyst predictions to create the estimated earnings per share growth. To create a valuation, I'm going to give Teladoc a 10% growth rate. Then, I am going to give them an estimated PE ratio of the S&P of 28. After that, I will project these numbers forward by 10 years. Then I will reduce my return to just 5% for this investment. This then gives me an estimated future stock price of about $14.52 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $9. Then we apply a margin of safety. At 25% it gives me a buy price of about $7. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. Please consider sharing this video with someone you think will like it, and click on the link above to learn how to create your own earnings per share growth model. The return we would receive if we bought at our 25% margin of safety price of $6.69 and sold in 10 years' time at our estimated future stock price of $14.52 would be 107%. But this is dependent on our assumptions for the company being correct. In addition, Teladoc don't provide a dividend. If you have enjoyed this video, let me know in the comments section. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Teladoc scored just 3 out of 12. So not surprisingly, I will give them a cross. As for the past results, over the last few years their share price has been trading downwards, but has taken a significant dip since 2022. Therefore, I will give them a cross. Analysts are signaling Teladoc as a hold, although they predict they will begin to grow again starting in 2026. However, I will give them a cross for this. Using the EPS growth model I used earlier on, we created a buy price of about $7. But it was overvalued and didn't provide much in the way of a return. Therefore, I will give the valuation a cross. According to Morningstar, Teladoc don't have a moat. So, I will give them a cross. My final overall rating is 0 out of 5 stars. And like Intel last week hasn't received any stars at all, I have given this a category E rating within my own stock watch list, which puts it in my avoid pile. Thank you for joining me during this stock analysis video, and I hope to see you in the next one.